Hey, what's up guys? Today we're going to be talking about conventional mortgages. In this video, I'm going to go over what the requirements to get a conventional mortgage are. I'm going to give you some tips on how to save money, and I'm going to give you some tips on how to decide if a conventional mortgage is the right loan for you. So let's jump into it. Hey guys, I'm Ben Sund. Welcome to my channel where we talk about improving our overall financial health through things like personal finance, investing, and real estate. So what is a conventional mortgage? Well, a conventional mortgage or a conforming mortgage is one of the four major types of mortgages. You have conventional mortgages, you have FHA mortgages, which are a government-funded mortgage. I made a separate video you'll see up here somewhere. Then you have a VA mortgage, which I also made a video about. If you check out my mortgage playlist, you'll see all these videos. A VA mortgage is a veteran loan, so you have to be a military veteran to qualify for one. And then the last mortgage would be a rural development loan. I haven't made a video on that yet, but a rural development loan means that you have to buy a home outside of the city in a rural area. And I'll make a separate video on that as we go along. Again, it'll be added to the mortgage playlist. So a conventional mortgage and an FHA mortgage are the two most common mortgage types that you're going to run into. Those just refer to the guidelines that the bank or the lender use in order to qualify you for the loan. And we'll talk about more of those requirements in just a second, but typically a conventional loan is going to be the type of loan that you're going to look for if you have pretty good credit. So really anything above 680, conventional is going to be the most beneficial to you. It's also going to be more beneficial if you're looking at buying a second home or an investment property. That's usually the route you're going to want to go, is conventional. Now FHA is going to be the route that you're going to want to go if you don't qualify for VA or rural development. FHA is going to be the route that you want to go if you have subpar credit. So really anything under 680, most lenders are going to look at FHA for you. It'll kind of depend on your down payment. Again, we'll get into all that in just a second. I just wanted to give you a little comparison or a little guideline breakdown to go off if you're looking at conventional or FHA, because those are the two most common loan types that you're going to see. So we're going to break this video down into a couple different sections to make it easier in case you don't want to watch the whole video. Again, I'll have additional resources in the description down below, and I'll try to put tags in so you can sort through and see, like if you just want to learn the credit scores, you can go directly to that tag. So the first section is going to be the term available, and the term means how many years you get the loan for. So a conventional mortgage is going to have 10, 15, 20, and 30-year terms. They can come in both fixed rate and adjustable rate. Fixed rate meaning that once you close on the mortgage, the rate won't adjust for the life of the loan. So if you have a 30-year mortgage, you'll have that rate for 30 years. Now, an adjustable rate means that the rate can change at any time. Usually lenders have to give you a little notice, but the rate can change at any time. In 2022, I recommend doing a fixed rate because rates are fairly volatile right now. And really fixed rate has been the way to go for quite a while now. So I would recommend doing a fixed rate, or at least asking your lender what the difference is or what the cost difference would be on a fixed rate. But generally speaking, that's going to be the route that you want to look for. And along with the fixed rate over an adjustable rate, it doesn't just mean that your interest rate won't change, it also means that your payment won't change. So if you have a 30-year mortgage, your payment's not going to change for 30 years. Aside from like taxes and insurance, those things are going to adjust as your property goes up in value, and the homeowner's insurance, your homeowner's agent's going to adjust the price. But generally speaking, your payment's going to stay pretty steadily, so you can budget for that. So the next section is going to be cost and down payment. On a conventional mortgage for a primary residence, meaning a home that you're going to live in, it's not going to be a rental or a second home, the minimum down payment is going to be 3% down. And your interest rate is going to be greatly dependent on your credit score, and you might even have to put more down. So if you have weaker credit, say under 700, you might be required to put 10% down instead of the 3% because it's a much riskier loan. And so that's something that you'd want to talk to your lender about, because another loan like an FHA loan might be better for you because that would require less down payment, and you wouldn't get as big of a credit hit, or an interest rate hit, because you have, let's call it subpar credit. Again, something that you can talk to your lender about, but if you have good credit, you can put 3% down. Now, if you're buying a multi-unit, say a 2 to 4 unit property or an investment property, you might be required to put between 15 and 20% down. And in some cases, you're going to be required to put 25% down. Again, it's going to depend on your credit, but those are the down payment requirements minimum. And if you're buying a second home, again, this is not the same as a rental property. A rental property is a property that you're going to be renting to someone else. A second home is going to be a property not like your primary residence. So think beach home or like a waterfront property or somewhere farther away from your primary residence. Usually it has to be about 30 miles away. It's going to be something that you would use as like a vacation home. Those are going to require at least 10% down. Now the plus side with those is you can still rent those out for part of the year, as long as you're going to be residing in it for some part of the year. Then you can still rent those out and collect rent and have the advantage of putting less down. Now let's talk about the costs. We talked about the down payment, and the down payment is not the only cost to do a mortgage. You're going to have things called closing costs and prepaids, which are escrowed taxes and insurance. Basically, a lender will take your taxes and insurance and they will collect a portion of what's due and put it in a checking account for you. So when that comes due, they will pay that for you. It's required on most loans if you don't have a 20% down payment. And the closing costs, they can vary greatly. So the closing costs can be between 3 and 6% of the mortgage. So if you're buying a $200,000 house, it could be anywhere between $6,000 and $12,000 that you would have to put down in addition to your down payment. So on our $200,000 example, you could have $6,000 down payment, you could have another $6,000 in closing costs, and then you could have anywhere between, it really depends on where you live, but you could have another couple thousand, let's call it 2,000, in prepaid, so your taxes and insurance. So at the closing, you could expect to have around $14,000 in costs, and if you don't plan for that, thinking that you only have to put 3% down, it might affect the deal, or it will affect the deal, and it might completely kill your ability to get the home. Now, I do have a couple tips on how to save money and how to reduce that overall cost. We'll go over that a little bit later in that section, but I just wanted to give you an underlying, you can't just go in planning on having the 3% down payment. You have to factor in these other costs. So let's talk about what types of homes you can actually buy with a conventional mortgage. This is one of the advantages of a conventional mortgage, is that you can buy a wider variety of homes, whereas FHA or VA don't allow for. So like I said earlier, a conventional mortgage, you can buy investment properties, second homes, you can buy a primary residence, but that also means that you can buy a 1-unit home, you can buy 2 to 4 unit homes, you can buy condos, manufactured homes. They have a wide variety of all these different types of properties that you can buy using a conventional mortgage, as long as you have the credit and income to qualify for. And again, the other loan types don't allow for it. So on an FHA loan, for instance, it has to be a home that you're going to live in. Same with a VA loan. You can buy multi-wide or multi-unit properties with those, but you have to live in it. And you also can't buy a second home with those or any other type of investment property. It has to be for you to be living in full time. All right, so in this section, let's talk about credit. One of the major downsides of a conventional mortgage is it requires you to have a higher credit score. So FHA, VA, and rural development all allow you to have lower credit scores than conventional, generally speaking. Each lender can have what's called an overlay, meaning the lender might require a higher credit score than what the guidelines say. So for instance, as a lender, I might require a 700 minimum credit score, whereas other lenders might require a 620. Typically, you're going to see for conventional, 620 to be the minimum. For FHA, you could qualify for an FHA loan with only a 580 credit score. With conventional, the other downside, and like we talked about earlier, is that the higher your credit score, the better the rate, up to a 740. Meaning anything above 740, your interest rate's not really impacted. But as you get below your 740 credit score, as you dip down, the rate goes up down to the 720, whereas an FHA loan, you can qualify for 580 and you don't take a big interest rate hit for having a 580 credit score. Now, as a little side note, 620, as I said, is usually the minimum for conventional, but that's on a primary residence or a home that you're gonna live in. Generally, you're gonna have to have a much higher credit score, like a 680 or 700, to qualify for things like construction loans, second homes, and investment properties. Those are gonna require higher credit scores, again, usually in the 680 to 700 range. So one of the most important parts of a loan is how are you gonna pay for it? So in this section, I'm gonna go over the income requirements or the things that you're gonna be asked about when you're getting a conventional mortgage. A conventional mortgage requires that you have 2-year job history. Now that doesn't mean 2 years on the same job, unless you're a self-employed business owner or a 1099 self-employed or independent contractor, then you're gonna need 2 years on that exact job or owning that exact business. One of the nice things is that to supplement some of that 2 year of employment history, again, except for if you're self-employed, you have to have 2 years on that job. But one of the things that you can supplement it with are school transcripts. So if you're in college and you don't have quite a full 2-year history, as long as you have stable employment, then you could supplement part of that 2 years with college transcripts. Or if you're in the military, you could have part of that 2 year be military pay, or military service. But you will need to have been on your current job for at least 30 days to so that you have pay stubs or like proof that you've actually been working at that job. And if you're a temporary employee, that doesn't instantly disqualify you, but you're gonna have to be able to provide proof or have the company that you're working for be able to provide proof that you're not constantly switching temporary companies or that you're not constantly switching temporary assignments. You have to have something that is stable and likely to continue is how lenders look at it, meaning that you have to have somewhat stable in the temporary work, like a contract or proof of contract extensions showing that you're able to hold employment. And so a lender is going to ask you for income docs in order to provide proof that you're employed and that you have stable employment. And so if you're a normal W-2 employee, meaning you work at like a Walmart or a big company, an employee that shows up, you're not paid on commission, they're gonna issue you a W-2. And so you're gonna want at least 2 years W-2s handy. You're gonna want a recent pay stub, meaning a pay stub within the last 30 days. And then you're gonna want 2 months bank statements showing that you have the money to close, but also it'll show that you have direct deposits from your company into your account. That's not completely necessary to show, you don't have to have direct deposit is what I mean, but it's good to have those handy just in case a lender asks for. And if you're self-employed or an independent contractor, or if you're retired, you're gonna wanna have 2 years federal tax returns in any 1099s or Social Security awards letters or however you get paid in retirement. You're gonna wanna have the, proof of that handy for 2 years. And then again, 2 months bank statements, just showing proof of deposit or proof that you have the money available to close the loan. So the final and probably the most important section is going to be what's called debt to income ratio. This is the calculation that lenders use to determine if you qualify for a loan and how much of a loan you qualify for. And so the debt to income calculation looks like this. Let's say you make 10 grand a month. You have 2 grand in like credit cards and car loans, personal loans, student loans, 2 grand per month payment, and you're trying to buy a home with a $3,000 a month payment. You're gonna have a debt to income ratio of 50%. So the debt or the payments that are included in that 50% are gonna be things reporting on your credit report. So things like credit cards, car loans, personal loans, student loans, or any expenses that have to do with other properties. It's not going to be things like utility bills or food or savings. And on a conventional mortgage, you're gonna be able to go up to about 48% of your income going towards debt, including the home that you're trying to buy. Now, as a side note here, your lender isn't going to use your take-home pay. Your lender is going to use pre-tax, so before you pay taxes, that would be your top line on your pay stub. Your lender is going to use that income for you to qualify. So if you're going up to the 48% debt to income ratio, you're going to be overbuying your home. As a general rule, you want to be buying 35% or no more than 35% of your take-home pay, so your net pay on the bottom of your pay stub. That's the number that you're going to want to do, and you're going to want to set your own budget for it and let your realtor and your lender know, because again, if you let them or you tell them, hey, qualify me for the maximum, then they're going to go to that 48%, and you're going to be what's called house poor. It means that you're going to be buying too much home for your budget, and they can actually approve you for that on paper, but again, you're the one stuck making the payment. Now keep in mind, lenders aren't going to take into account things like food, which I think is pretty important, or savings and retirement, or car repairs, or taking your dream date out on a date. I mean, the last thing that you want to do is get stuck taking your date out to Arby's because you bought too much house. All right, and so finally, to round out the video, I'm going to give you those tips on how to save money. A few of them are going to be what to do before you purchase the home or before you close on the home. And then the last one is going to be what to do after you close on the home. This is going to be the most important one because it's the one that's going to save you the most money. And so tip number one is to ask your realtor or ask the sellers to pay some of your costs. Remember, as I said, that some of the costs could be between $3,000 and $6,000. Well, on a conventional mortgage, the sellers are allowed to pay up to 3% of the purchase price. So if we use our $200,000 example, the sellers could potentially pay $6,000 of your costs for you to buy the home. This happens quite a bit, actually, and it happens in every market. You just have to have, you have to have your realtor, or you have to have the ability to negotiate that. But it could save you, again, on our $200,000 example, it could save you $6,000 in costs that you don't have to come out of pocket for. And so that's something that a realtor might not bring up because it could make the offer look not as strong, but it's something that you want to talk to them about because, again, $6,000 is $6,000, and if you don't talk to them and they don't bring it up, and the sellers are willing to pay it, you could potentially be missing out. And now tip two is to ask your lender about down payment assistance. Each area or each state is going to have their own down payment assistance available to them, and some lenders have their own programs. So you're going to want to talk to your lender and just ask, is there anything that you qualify for that could help with that down payment? Because again, we said the minimum at the start was 3%. That doesn't have to be out of your own pocket. A lender could potentially give you part or all of that 3%, or give you money on top of that to help you get into the home or help you save money for your down payment. For example, I, as a lender in my area, can offer $3,600 in down payment assistance to qualified buyers. It depends on where you live and what your credit score is, and there's a few other income requirements. But lenders are going to have different options available. And if they don't, I suggest calling a couple different lenders just to see if any of them, like, they'll give you a brief conversation, like how much you make. They don't have to pull your credit necessarily if another lender already did that. But they could give you a quote on, yeah, we have, $3,600 or $10,000, depending on what your credit and income is. We have that available to you. That instantly could save you thousands of dollars, or it could at least free up some of your money that you already have so you can use it towards other things like moving into the home or buying furniture, stuff like that. And so those are the two options that you're going to want to talk about before you actually close on the loan or before you actually get a home. One of the best things is you can use those two in combination. So you can get your lender to give you down payment assistance, and the sellers can still pay some of your costs. So you could potentially be closing on a loan with no money out of your actual pocket. And now the final tip, again, this is going to be after you close on the mortgage, but that's going to be make one extra principal payment per year. And what that looks like is you go to your bank or you set it up online and you just say, I want to pay one extra principal, meaning it doesn't go to your interest, it just pays down the principal or the amount that you owe on the mortgage. What this does is it brings you down what's called the amortization schedule, meaning it shortens how long you buy or how long you owe that loan for. That one means that you're going to pay off your home early, but it also means that you're going to pay drastically less interest. So because mortgage interest is calculated on how much you owe on the mortgage. And so when you pay that down, and you only have to do it once a year, you can do it as many times as you want. But the rule is generally if you do it once a year, you're going to pay your home off probably 5 to 8 years sooner if you're on a 30-year mortgage. But that's going to result in thousands and thousands, probably tens of thousands, depending on how expensive your home is. That's going to result in you paying that much less interest. And you can go on websites like Bankrate, or just Google amortization schedule, and you can play around with those numbers. But it's going to tell you, like, if you pay an extra $200 a year down or an extra $1,000, just depending on how much your payment actually is. But you can play around with that, and that's going to show you exactly how much you save in interest and how much sooner your mortgage gets paid off. So again, this could save you thousands of dollars, and you can just plug it in. All right, guys, I hope you got some value out of that. I've had my say. Now it's time for you to have yours. Comment down below, is there any other mortgage-related videos or personal finance-related videos that you'd like to see? Or do you have any questions about a conventional mortgage? Is it something that you're thinking about looking at? Or do you already have one and you want to know more on how to save some money? Comment down below, and I really appreciate it if you would like and subscribe to this video. It really helps out the channel. It's going to help me produce more and more videos. Again, I don't just talk about mortgages. I also talk about personal finance and real estate investing. So if you like what we're doing, please hit like and subscribe, and we'll see you on the next one.